In this tutorial, I'd like to talk to you about the money market in the short run. This is sometimes called the liquidity preference model. The primary assumption of this model is that households hold their wealth in two ways: money, that liquid asset that you can use to purchase goods and services, or bonds. Money is considered currency and bank balances. We assume that money balances do not pay interest, but bonds do. And we group all interest-bearing or return-bearing assets into this alternative non-money category that we generally refer to as bonds. So let's think about why hold any of your wealth as money. Primarily, you want to buy stuff. You want to purchase goods and services. So you have money in your wallet and you have money in your checking account that you're going to use to buy stuff. You may also set some money aside for unplanned expenditures. Now, how much is that? Well, both of these categories, both 1 and 2, depend on what the price level happens to be. All else held constant, higher prices means you need more money or dollars in your wallet or dollars in your bank account to purchase goods and services. And your income, your real income. If your real income increases, there's going to be more money in your wallet and more money in your checking account because you're going to buy more stuff. Now, you may also hold money for speculative reasons. Money is a store of value, and you may be uncertain about the value of those other interest-bearing assets. You don't know what the price is going to be in the future. Depending on what you think is happening in these other markets is going to determine how much you hold as money. For example, you think stock prices are going to rise tomorrow. You're going to hold less money and you're going to buy stocks. If you think prices are going to fall tomorrow, you're going to liquidate your non-monetary balances and shift it into your checking account for a little while. That can cause fluctuations in money demand, maybe more so than transactions demand. Monetary assets do not yield interest. So if you are holding money in your checking account or in your wallet, you give up the interest that you could have earned if you held bonds. So the opportunity cost of holding money is the interest rate. We're going to think of that as the price of money. And what that's going to give us is a nice negative relationship between the quantity of money demanded and the interest rate. So we're going to get a nice downward sloping money demand curve that's going to look like the demand curve for shoes or apples or anything else. So let's take a look right now. Here's the price of money, the interest rate. Here's the quantity of money demanded. So let's start here, maybe with an interest rate of I0. And suppose at an interest rate of I0, households choose to hold M0 quantity of money. If the interest rate rises, those bonds are more attractive, and we're going to shift some of our wealth holdings from money into bonds, and the quantity of money demanded decreases. The interest rate falls, holding those bonds is less attractive, and we're going to hold more of our wealth as monetary balances, and we get a nice downward sloping money demand curve. Well, next, we need to add supply. And the money supply is fairly easy because the money supply is determined by whatever monetary regime we have in our economy. In the United States, the money supply is controlled by the Federal Reserve. The money supply is independent of the interest rate. So if the interest rate goes up or the interest rate goes down, fluctuations in the interest rate don't influence the quantity of money. Take a look. Let's suppose the central bank chooses a quantity of money of M0. If the interest rate is I0, that's the quantity that the Fed chooses. If the interest rate goes up, for whatever reason, we're not taking a stand on why, the Fed still chose the same quantity of money. So this means our money supply curve is vertical at whatever quantity the central bank, or that's determined by whatever monetary regime we happen to have. Let's put them together. Money supply, money demand gives us our equilibrium interest rate. So what we have is we have the price of money that's clearing in a money market. And now we can use our theory of liquidity preference, talking about our money demand and our money supply, to explain why we might experience fluctuations in the interest rate. overall the objective of this model. Let's pick something to change. Let's start here at I0. Let's have an increase in the money supply. So an increase in the money supply causes a decrease in the interest rate. Let's try another one. Let's say an increase in income. An increase in income is a determinant of money demand. If we have more income, all else held constant, we're going to keep more dollars in our wallets and in our bank accounts, and our interest rate is going to increase. One more. Let's try an increase in price level. Holding our real income constant, if we have an increase in the price level, we're going to have to keep more dollars in our checking accounts and in our wallets to purchase the same quantity of goods and services. Money demand is going to increase and our interest rate is going to increase. So I hope this video helped you understand the liquidity preference model and how we might use it to explain changes in the interest rate.